36% of $200,000 earners live paycheck to paycheck. Income is not wealth, never has been. The highest earning decade is statistically your most broke. More money, more spending. The math always wins. Two people, same salary. 40 years later, total opposites. The difference is never the salary, it's the system. Lifestyle inflation is the silent account killer. Every raise spent is a retirement delayed. Debt compounds against you. Savings compound for you. Americans save less than 4% of their income. Europe saves 12%. The gap is a choice. 65% of Americans live paycheck to paycheck. Net worth grows in the gap between income and spending. Looking rich and being rich are opposite strategies. The median 401k balance at age 44 is $39,000. The target at 45 is 3 times your annual salary. Most people are decades behind. That's fixable today. Wealth is built quietly. Nobody ever sees it happening. Tracking your money is the first act of ownership. You cannot optimize what you do not measure. High earners feel rich. Asset owners are rich. Assets generate income while you sleep. Expenses never stop. The car payment is the most expensive financial habit. Credit card interest averages 20% annually, compounding against you. Every dollar in debt is a dollar that can't compound for you. Only 45% can cover 3 months of expenses. No emergency fund means one event destroys your portfolio. 3 to 6 months saved is your financial immune system. Freedom is not a salary, it's a ratio. The hamster wheel pays well, it never stops spinning. Status spending is the tax the wealthy never pay. Stealth wealth is invisible by design. That's the point. Most millionaires drive ordinary cars and live ordinary lives. The Toyota driver with $1 million portfolio wins, always. Subscriptions quietly drain hundreds each month. $200 monthly in subscriptions is $2,400 a year. Every lifestyle cut is an investment in disguise. The wealthy buy assets. Everyone else rents them experiences. Time in the market always beats timing the market. The earlier you start, the less discipline it takes. Starting at 25 beats starting at 35. Dramatically. $500 a month at 25. 1.3 million at 65. 1,000 a month at 35 only reaches 600,000. Time is the asset nobody can buy back. And the part nobody fully explains the actual mechanics, that's what we're getting into now. The system starts with one number, your savings rate. Nothing else matters first. A 15% savings rate is the minimum floor for real wealth building. Pay yourself first, every paycheck, before a single bill is touched. Automation removes willpower from the equation entirely. That's the point. Your income is not your wealth. Your savings rate is, full stop. The 401k employer match is a guaranteed 100% return. Capture all of it. Maximum your 401k first, then fund your Roth IRA in that order. The Roth IRA contribution limit is $7,000 a year in 2025. Inside a Roth IRA, your growth and withdrawals are completely tax-free. Peter Thiel turned a Roth IRA into $5 billion, tax-free. VU tracks the S&P 500. It has averaged roughly 10% annually since inception. VTI gives you the entire U.S. market over 4,000 companies in one fund. SCHD pays a growing dividend. Morningstar rates it gold for risk-adjusted returns. QQQ focuses on technology growth. Its 1 0-year CAGR is over 18%. A 3-fund portfolio VTI, International Index, bond fund covers everything. Diversification is not about owning more. It is about owning less of the wrong things. Expense ratios destroy returns over decades. VOO charges just 0.03%. A 1% fee difference costs over $100,000 by retirement. Index funds outperform 80 to 90% of actively managed funds over 20 years. The best investment account isn't the highest return, it's the one you actually fund. Dollar cost averaging removes the fear of bad market timing completely. Invest the same amount monthly. You buy more shares when prices are low. Emotional selling during market drops is the #1 wealth destroyer. The S&P 500 has never failed to recover. Every single bear market reversed. Boredom is the investor's greatest enemy. Discipline is the weapon against it. Rebalancing once a year keeps your portfolio aligned with your risk tolerance. Tax loss harvesting offsets gains and reduces your IRS bill every year. Use tax-advantaged accounts first 401k, Roth IRA, HSA, before any taxable account. An HSA is a triple tax advantage pre-tax in, tax-free growth, tax-free out for medical. Real estate builds wealth through leverage, but only when the numbers actually work. Avoid private mortgage insurance. Put at least 20% down. Negotiate your salary. A 5 to 1,000 raise invested compounds to 40,000 over a decade. Side income invested not spent is the accelerator most people waste. A portfolio without a plan is a car without a destination. It moves, but it never arrives. The numbers don't lie. But there's one piece almost everyone still gets completely wrong, and that's next. Compound interest is not a math concept. It's a boulder rolling downhill slow at first, then unstoppable. The first decade of investing barely looks like progress. The third decade looks like magic. At a 10% return, money doubles every 7.2 years. That's the rule of 72. $10,000 invested today becomes $80,000 in 21 years at that rate. Most wealth is built in the final 10 years. The early years are just buying the ticket. Vanguard data, consistent contributors grew balances 12% in 2024 alone. Market downturns are not disasters for investors. They are discounts on future wealth. VOO in 2022, down 23%. VIEW in 2023, up 22%. Net, positive. The investors who stayed fully invested during 2022 captured all of 2023's recovery. Missing just the 10 best trading days per decade cuts your returns nearly in half. Inflation erodes cash savings at roughly 3% annually. Inaction has a real cost. Holding cash beyond your emergency fund is a slow financial bleed. High-yield savings accounts earn 4 to 5%. Use them for your emergency fund. Never invest money you will need within the next 3 years. Markets are volatile, short-term. Your asset allocation should match your time horizon, not your feelings about markets. A simple rule: subtract your age from 110. That's your stock allocation percentage. At 65, Social Security replaces about 40% of pre-retirement income per SSA data. That 60% gap is what your portfolio must cover. Plan backwards from that number. The 4% withdrawal rule: $1 million sustains $40,000 per year indefinitely. To retire on $80,000 per year, you need $2 million in your portfolio. Work backwards. $2 million at retirement means investing roughly $1,000 a month starting at 30. Most Americans are drastically underfunded for retirement. Only 35% feel on track, per the Federal Reserve. Debt avalanche method. Attack highest. Interest debt first. Minimum payments on the rest. Eliminating a 20% credit card balance is a guaranteed 20% return. Student loans under 5%. Invest alongside. Over 7%, prioritize payoff first. Insurance is not an investment, it's financial infrastructure. Underfunding it is the real risk. Term life insurance protects your family cheaply. Whole life policies benefit the seller, rarely you. Spending money on experiences that build skills is an investment. Spending on status is consumption. Your network increases your net worth. The data on income peer influence is overwhelming. You now understand the system. The only piece left, the hardest one, is whether you'll actually build it. Building wealth is not complicated. It is uncomfortable. Those are two completely different problems with different solutions. Over 60% of six-figure earners live paycheck to paycheck. The problem is never income, it's management. Step 1. Calculate your exact monthly cash flow. Income minus fixed expenses equals your financial raw material. Step 2. build your emergency fund first 3 months minimum in a high-yield savings account at 4% plus. Step 3. Kill high-interest debt. Anything above 7% is a guaranteed negative compound machine. Step 4. Capture your full 401k employer match every single dollar. That's your first guaranteed return. Step 5. Fund your Roth IRA up to $7,000 annually, then invest inside it in VOO or VTI. $7,000 annually in a Roth IRA over 30 years at 10% grows to over $1 million tax-free. VOO plus SCHD gives you growth and income in one simple 2 ETF core portfolio. SCHD's 10-year total return places it in the top 4% of all large value funds per Morningstar 2024. The boulder analogy is not poetic. Year 1 of compounding adds hundreds. Year 30 adds hundreds of thousands. Reinvesting dividends automatically is the silent accelerant most investors ignore completely. A $1,000 monthly investment at 10% grows to $206,000 in just 10 years. That same $1,000 monthly grows to $678,000 over 20 years. The math accelerates dramatically. Cancel unused subscriptions. Cook at home 4 nights weekly. Negotiate rent. These are not sacrifices, they are portfolio contributions. Saving $300 more per month and investing it is $108,000 richer in 15 years. The spending audit. Print 3 months of bank statements. Every dollar gets a category. No exceptions, no blind spots. Most people discover $200 to $500 in monthly leaks from their first spending audit. That money belongs in your portfolio. The 50-30-20 rule: 50% needs, 30% wants, 20% savings minimum. Wealth is the boulder, rolling downhill, gathering everything in its path. Your job is just to let it roll. Tax brackets reward behavior. Long-term capital gains are taxed at 0% for most middle-income investors. Holding ETFs for over 1 year converts your gains from ordinary income to long-term capital gains tax rates. The wealthy do not work for money. They build systems where money works for them around the clock. Passive income from a $2 million portfolio at 4% generates $80,000 annually without touching the principal. Financial independence is a number, not an age. Compute yours and reverse engineer the path. Sequence of returns risk in early retirement is real. Keep 2 years of expenses in cash or bonds as a buffer. Delaying Social Security from 62 to 70 increases monthly benefits by up to 77% per SSA data. A bridge investment account lets you retire early while waiting for Social Security to maximize at 70. Review your financial plan every year. Not to panic, to calibrate. Markets move, life changes. Your system adapts. The boulder does not stop for market downturns. You just have to resist the urge to push it back uphill yourself. The stealth wealth lifestyle is not about deprivation, it is about intentional allocation, every dollar with a purpose. The person nobody suspects of being wealthy is usually the one who actually is. That is the stealth wealth paradox. Frugality without investment direction is just poverty with better discipline. Direct every saved dollar into assets. A 10% savings rate gets you to retirement eventually. A 25% savings rate gets you there in 15 years. Every percentage point increase in your savings rate compresses your time to financial independence significantly. Increase your income, but protect your lifestyle from expanding to consume it. The gap is everything. After a raise, automatically redirect 50% of the increase to investments before you adjust your lifestyle. Peer pressure is the most expensive financial force in a consumer society. Your peers cannot retire for you. The BLS shows the average American spends $1,700 annually on dining out. Redirected, over $250,000 by retirement. Consistent small actions, compounded over decades, are more powerful than any single large financial move. Your financial identity shapes your financial outcome. Decide now, are you someone who builds wealth or someone who earns and spends? The system is 5 steps: cash flow, emergency fund, debt elimination, tax-advantaged accounts, and index fund investing. Step 1 this week: open a high-yield savings account and a Roth IRA. Both take under 20 minutes online. Step 2 this month: Run the spending audit. Print statements, categorize every line, identify your 5 biggest leaks. Step 3, this quarter. Automate your savings and investment contributions. Remove every decision from the equation.